working on Unit 2, pages 11 through 17. We're going to be talking about, since they're in objectives, financial markets, it's from the state standards, but in particular we're talking about savings accounts. It's not just as simple as a place to store your money. We're going to be talking about what kind of options can actually not only save, but actually make you money. Pretty exciting. So let's go ahead and get on. First, we are going to be working on, I know I said 11 through 17, but actually pages 11, 13, and 17. 17, we're going to do the whole page. 13 and page 11, cross out time deposit, cross out tax-exempt bonds. Pages 12, 14, 15, 16, and 18, it's all on the screen. Just leave them blank. Just leave them blank. You don't have to go do them with the textbook. Just leave them blank. So you might want to pause, cross out what needs to be crossed out, and continue. So, introduction to savings. Some of this on this screen won't be real news to you. Savings is the setting aside of income for a period of time so that it can be used later. Great. There's a number of things you should think about when saving. What are your reasons to save? What are you trying to accomplish? Are you just trying to save up for a car so you can have better transportation? Are you trying to save up for a down payment for a home? Are you looking forward ahead to retirement so that one day you can quit work earlier than maybe others will, but not have to sacrifice financially? I mean, all kinds of things you could be saving for. What amount of funds to set aside? Like what percentage of your income or a flat number? Like what can you afford to set aside? What is worth it to you to set aside and not spend while you're saving? Decide what type of account you will use. That's going to be the crux of today's lecture. We're not going to go into every single thing. There's tons and tons of options out there. But I'm just going to give you a taste of what's out there besides just basic savings accounts. The last two steps are definitely things you want to think about. We're not going to go too much into detail because again, these are very personal. Most of these courses are fairly personal. But what type of account you will use? This is the point. So, shopping to save. What does that mean? What do you mean you shop to save? Saving means you're not spending money, and that's true. But just like in comparison shopping, you're looking at all the different options of a product and what will give you the most benefit for your money, the most pleasure, or will satisfy your needs and wants. Well, it's the same thing for finding a savings program. Most people just go, oh, I need to save, so I guess I'll put it into a savings account, which is fine, but that's not the only option out there. And most of them don't have the word savings in the title, and yet that's exactly what they're for, saving money and earning money. So when you're shopping to save, the trade-offs that you're going to be comparing what are you going to give and what are you going to get. One is minimum balance. Some things like a savings account may not require a minimum balance or a very low one. Others that have a high amount of reward, they have a very high minimum balance. So what can you afford? What makes sense for your financial situation? Accessibility. Some, like, you can access whenever you want, as much times as you want. Like an ATM machine. You can just use your card. You can do it electronically. You can write checks. You can go to the bank. Other things can be very inaccessible. Like maybe you can't touch the money at all for a period of years. And lots of choices in between. Interest rates. Interest rates meaning when your money's sitting, how much money are you getting? Because when you invest in a savings account, even if it's not called a savings account, the different options we'll talk about, you are effectively loaning money to that company. That's right, the banks, when you put money with them, they're using your money to invest in other things to make money for themselves. Now, you're protected. You don't have to worry about them spending your money. The government makes sure that if you want your money back, you can get it like that. Well, for your basic checking and savings. So why would banks get out of letting you put money? Well, they get to spend money, and their incentive to you to come to them and put it into a savings account or some other account for saving of a different name is that they're going to pay you interest because you're loaning them money. The more money you give them, the more money that they have to use. So they want to incentivize you, not just as a safe place, so that is a strong incentive, but also like, we're going to make you money if you give us more money to use. And then finally, safety. There are some accounts where, like I said, government ensures that you will get your money back anytime you want. No questions asked, you just get it. But then there's other kinds where, no, it's possible you might invest your money and things can go wrong and you don't get it back. You lost it. So these are all the different trade-offs, different things to think about when shopping for a savings account. So basic savings account, very safe. You're government insured. Up to $100,000. So now if you put in more than $100,000, the government doesn't guarantee you get that money back. The only reason why you wouldn't get the money back, though, is if for some reason the company went out of business. Or I guess maybe got robbed, like major. But for the most part, it's very safe putting your money into a savings account. Very accessible. There might be some limitations or a very small minimum balance and some requirements, but they're usually, not always, but usually pretty easy to meet, and you can get your money out of the account as often as you want with no or at least very small penalties. But very low interest. You're not getting very much money. You probably won't even get 1% of your money. You could put, if you put thousands and thousands of dollars in a savings account, while it's a very safe place to put it, because the government makes sure that you're protected up to $100,000, you're not going to earn very much if you're only getting 0.5% or 1% if you're really lucky. But these are very cheap and or sometimes even free depending on the requirements. So they're accessible to everyone. Money market deposit accounts. These are just like savings accounts. They're extremely safe. Like a savings account, the government insures you up to $100,000. It's less accessible because you generally can't use like your debit card. You can't attach it. You can't do like electronic balance transfer using, like your Bank of America online account. You kind of have to go to the bank. You might be able to write checks out of it. So it's still fairly accessible. You can get your money when you want, but it's not as easy as a pure savings account. But the interest rates are much higher. Because there's a little more difficulty involved, they're offering you a little bit more. So you can earn more money for letting it sit, letting your savings sit in the account without you touching it, than you could in a savings account. But they can be inexpensive to maintain. But somewhere between $1,000 to $2,500 is usually the minimum amount you have to put in to open the account and to maintain to keep the account going. That's why they offer higher interest rate, because they're asking you to invest more of your money and keep investing more of your money. As opposed to a traditional savings account, you could open it with like $1. I mean, I don't know if that'd be worth your time, but you could. Money markets, you're going to have to invest a little bit more to open one. Then there's time deposits, also very, very safe. These are definitely under the savings account umbrella, so insured by the government up to $100,000. That's true for all savings account like these. They're usually called certificates of deposit, CDs, but where the word time deposit comes from is that you put the money in and it's locked in there and you can't touch it. Almost no accessibility. Or if you do take your money out, you get zero benefit if you take your money out too early, before the agreed amount of time. The time could be a week, a year, it could be many, many years. The interest rates can be great. There's this thing, but you don't get any of that interest until the time limit that's set when you invest your money runs out. So a regular savings account, you'll get interest like every month. It keeps added to your account, adding to your account, adding to your account. But the interest rates for a time deposit grow in what's called maturity. So over the life of the loan or the savings account, the time deposit, you put your money in and it doesn't get bigger. You earn no money until it matures, and at the time that you agreed upon when you bought the time deposit, you bought the CD, and then it matures, and then all that interest comes in, boom, one lump sum. You get your money back, your investment back, plus all that interest all at once, as opposed to being able to take that interest out every month if you wanted to. So it's a bigger investment because you cannot touch that money, or you at least not without penalties, if you want to get that big reward at the end. And again, it's a very safe way to do it. And that's about it for savings account. So go ahead and move on to the video for the Unit 2, page 13. Don't forget to do the